That we kept hearing today was hope. Hope there's a deal in Europe. Hope that maybe the U.S. government, the Fed, starts putting more money into this market. That would be QE3. Well, I tell you what, let's bring someone in who can perhaps comment at all the above. He is Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. He joins us from the company's offices in Pittsburgh. Mark, it's always great to have you on the show. How do you make sense of all these headlines, and how do you possibly trade them?
Well, trading off the headlines has been very difficult to handicap, Adam, as you well know. It seems to be Europe on, Europe off on any given day. I think what we've seen in the last couple of weeks, though, is accumulating evidence here in the U.S. that at least it looks as though we're going to postpone, if not outright avert, a recession. And then, of course, earnings season on balance looks like we're set up for our 10th consecutive quarter in which we're going to see positive earnings surprises on a comparative basis. And, of course, as we all know, while nothing's yet definitive, we're trading on hope at the moment, which isn't much of a strategy, but nonetheless, that European officials will, in fact, get their act together and put forth some kind of a plan that not only helps to, if you will, ward off the Greek contagion, but as well do what is necessary to make sure that we don't end up with a Lehman-like event in the European financial system.
Understood, Mark. Yeah, hope is a tough one. Talk to me about your sense of valuation of this market and your target for the S&P 500. What are you telling your customers?
Well, it wasn't too many weeks ago that on an intraday basis we hit 1075 on the S&P 500. That's some 14 or 15% ago at this juncture. We thought at that time that had largely baked in a low-grade recession in terms of what the impact of even slower economic growth would mean to earnings estimates. So given the fact that we don't see that occurring, or even if we do, we still come out with the fact that stocks looks very reasonably valued, that is, at the moment, at about 10 or 12 times forward, depending upon how you might haircut earnings going into 2012, which puts us at a year-end value, in our opinion, of 1250 to 1300. And so we're looking at from here, particularly from a technical standpoint, breaching that 1230 level means the movement from here to 1250-60 looks like it should be fairly easy. And we believe in the Santa Claus rally theory, so we were long equities going into what we expected to be a fourth quarter rally.
Mark, you sound like you're able to stomach a little more risk than some of the other folks that we've had on over the last couple of weeks. What do you think about the corporate bond market at this point?
Well, I think there's elements in it that look very attractive. On one hand, since bonds are priced off of treasuries, and we know the 10 years around at 2.2 right now, it doesn't offer much of an attractive absolute yield on high-quality corporates that are so narrowly spread over and above treasury bonds. But where we find, I think, terrific value, once again, if your base case like ours is avoiding recession, is in the high-yield or junk bond market, but particularly in what we would call good junk, kind of an oxymoron. But that's in that BBB space where maybe you don't extract every last basis point out of the yield of the overall high yield market, but nonetheless at 7 or 8% is still very compelling, especially when if all you do is clip a coupon, you not only do better than other fixed income instruments, but arguably if we're in a low economic growth, low return environment, a 7% return thereabouts might rival the return that one could expect from equities going forward.
Hey, that's a great point, Mark. 7% return on bonds. Certainly that's something that a lot of people can relate to right now. What's your split between bonds and equities?
Sure. Well, for an average investor, a moderate risk investor, Adam, we would advocate a position of about 60 to 65% in stocks. With probably on the order of 25 to 30% bonds. We would also include some gold and as well as some other non-correlated alternative investment strategies, i.e. managed futures and long-short hedge funds. But on the equity side, I want to be very direct in terms of saying it's not any and all equities. It's large-cap, high-quality, dividend-paying equities. That's what gives us the comfort to be as long as we are equities, while at the same time knowing that they have the ballast to weather what could be continued volatility, since so much is still fluid and unresolved at this juncture.
Okay, large cap, high quality dividend paying U.S. stocks. Give me a few examples.
Sure. A couple of examples might include in the energy space, which is a complex in which we like a name by the name of Halliburton. While not a heavy yield at about 1%, here's a company that's trading about 8 times forward earnings, which is very unusual for an oil services company, and has a big footprint across North America, particularly in the natural gas space. A complement to that within the energy patch might be a Chevron, trading at 7 times earnings and a yield approaching 4%. Couple that with something perhaps in the tech tech space, which is a company that reported earnings yesterday, like Microsoft. Not terrific top-line growth, but the fact of the matter is, AAA rated company, $50 billion in cash, trading at 9 times earnings, a 3+% dividend yield, and a 10+% free cash flow yield. We think that derives prospects for terrific total returns.
Now, I'm a former oil trader, so I love hearing about the oil names. But on Microsoft, this stock has been flat for 10 years. Can you really get excited?
Well, if you bought it 10 years ago, no. But then again, you shouldn't have paid 35 times earnings for a company that was of the size and the growth path that Microsoft was on. But today, fast forwarding some 10 years, valuations aren't 35, they're 9 times. If you take out cash, they're closer to 7 or 8 times earnings. And we think a company of this size has the opportunity to unlock a lot of value. And so, of course, you have individuals like David Einhorn from Greenlight Capital, who's taken a big stake, kind of agitating management to do something about the company, which it could either do by splitting off pieces of his businesses or perhaps potentially increasing his dividend and or paying out a special dividend. So there's a lot of financial engineering, in other words, things that a big company like that can do to unlock value that we think exists over and above today's share price.
Mark, I'm going to ask you to hold it there because I want to bring in another guest now, Tim Mulholland, managing partner at China America Capital. He's joining us now from the CME. Let's talk currencies for just a moment, and I don't mean the euro, at least for now. Let's go to the yen. Talk about financial engineering, but it doesn't seem to be working for the Japanese government.
No, I think for the Japan to really turn the yen around, if they're going to intervene, they would have to have concerted effort from the rest of G7. I think really the currency moves today in general were really, I think, a lot in response to the renewed talk of a QE3 coming up. That's how the market really seemed to trade. And also, of course, on increased hopes at your own risk for some Eurozone, plan that's going to be at least meet expectations next week, which is a big if. So I think it was really the QE3 talk, and I think it was really wasn't any currency specific. It was just in general a dollar move.
Where do you think we go from here on the euro? Getting back to that topic, we're seeing the euro versus the dollar up. Not so much, not 1%, but not that far off. Do you think the euro continues to rally, or do you think it's completely headline driven?
I think it's headline driven, and I think it's in a downtrend. The issue was there was a huge short position. Hedge funds, I think, according to the records at the CFTC, had some of the biggest spec positions on record being long dollar, short euro, and I think you saw some of that unwind. But I think that at the end of the day, I think the euro on this rally is a sale.
Hey, Tim, it's Adam down here on the floor of the New York Exchange. I got to ask you, the prospect of QE3, it almost sounds a little concerning that they're going to have to throw more money at this, and yet markets rally. What's your interpretation? How far can they rally based on just a QE3 assumption?
I think at this point, not that much, because what we're getting, what they got out of the last QE3, I think was really disappointing. I mean, it could get a knee-jerk reaction in stocks, but the thing that really disturbs me that doesn't get enough attention, it's the QE3 coupled with this zero interest rate policy. I mean, Bernanke's given us a put for 2 more years. But I think what's really lost in the argument is there's $10 trillion in savings. This is American Institute of Economic Research put a report out. $10 trillion in savings, that's CDs and typical accounts that live off interest. And they're getting zero right now. And the numbers that they threw out, which I can't verify, but it has a direct effect on spending and employment to the tune of, over the past 3 years, perhaps as much as $500 billion in spending and maybe as many as 5 million jobs. But I think zero interest rate policy is really not getting the attention it deserves, because I think there's a lot of unintended consequences with that and directly on the income side. So I'm not really a fan of a sustained rally on QE3.
Hey, I appreciate that, Tim. I got to cut you off because Mark Luschini, you only got about 20, 30 seconds. Last word, do we get a deal coming out of Europe over the weekend or the next few days?
I suspect we're going to have the formulation of a deal. I don't think there will be anything definitive. Obviously, it'll ultimately need to be ratified sometime by Wednesday in the subsequent summit to the one that's occurring this weekend. I look forward to seeing something put together that will probably match expectations, but has some risk in it of underwhelming market participant hopes and dreams at this juncture, and we could end up forgiving some of the rally that we had today in anticipation of it being a shock and awe resolution.
Okay, Mark Luschini, Chief Strategist, Janney Montgomery Scott, thanks for joining us from Pittsburgh, and from Chicago, Tim Mulholland.